Coming up in today's video, we'll discuss the big drop in JOLTS job openings. China waives tariffs on U.S. ethane imports, which could show signs that China is relieving pressure on Chinese firms that import U.S. ethane for petrochemical production.
A lot of long words there.
And after the bell, we hear from Visa, which is of course a credit card company and a very important indicator of the consumer. And all I ask as we get started is that you hit the thumbs up button, subscribe if you're new. Let's get into it. So taking a look across the market here this morning, you can see the S&P 500 and the NASDAQ and the Dow and the Russell are all up a little bit here, basically spiked down and then found some buyers pushing things back towards fresh session highs. Gold is slumping a little bit here with Bitcoin trading flat and oil continues to move lower alongside the dollar. And following up on our thought from yesterday's video, it does look like the S&P 500 is trying to break out of this key level that we've discussed several times on my channel. And in today's video, I want to highlight a couple key charts that you need to be watching for signals that the NASDAQ, S&P 500, and most markets are potentially shifting into a risk-on mode. Stay tuned. And so the easiest one to start with this thought of potentially shifting back into a risk-on environment is if we draw a simple trend line on the NASDAQ 100. What you can see here is that sellers, which have been in control, seem to be losing grip on this market. In fact, we put in this low and technically have been trying to carve out some higher lows, but what really sealed the deal for me here in terms of looking bullish now is that it does seem like we were actually able to take back and capture that key level that we've discussed each day on the videos and streams, which is that Wednesday 90-day pause pop. So we had the 90-day pause. Price faded from there, but now has recaptured that area and actually closed decidedly above it. So where does that take us from here? And can we trust this rally? And even more importantly, for people who don't trade indices, what does this mean for the US dollar? What does it mean for gold? What does it mean for Bitcoin? Well, one thing that works against us here today is if we zoom into our actual versus forecast number on JOLTS job openings. JOLTS job openings came in a little soft here today. We saw the actual number at 7.19 million compared to the forecast at 7.49 million. But despite the softness in labor market data, we can still see the NASDAQ is getting a very bullish reading overall. Institutional money is where I want to go next. When highlighting the NASDAQ, we can see that in the latest COT filing, there was an increase in longs and a decrease in short positions. This shows us institutional money seems to be buying. Also, we can take a look at the 10-year yield, and we can see that it's now starting to trend lower once more. This is a good sign showing some stability in the bond market. And one of the more obvious risk-on indicators would be Bitcoin right now, which is actually showing some relative strength. While other markets have been kind of faltering, we see Bitcoin trying to break out above 95,000. In fact, this to me is a huge indicator that we could see some continued upside move in other risk-on areas, because Bitcoin is often a reflection of risk sentiment in the markets. When people are scared, they sell Bitcoin. When people are optimistic or willing to take some risk, Bitcoin gets a bump to the upside. Another thing to note is oil prices are still trending down. This is a positive thing for the inflation story. And as long as we keep oil in the general area that it's currently at, I think that's a positive catalyst. What do I mean by that? Well, if oil prices crater lower, that would likely be a scenario in which the market is thinking we're going into a recession. But contrarily, if we see a massive uptick in oil, that would also be negative, because that would indicate that, some sort of war may be happening, or we may get a spike in inflation. Really, where oil is at, we pretty much want it to stay. This is a good price range for oil, and this is a positive catalyst for the inflation story and for inputs on the global economy and for the input to the global economy. And while I still have a long position on gold with a stop loss below this structure lows, gold chilling out is a good thing for the index story, because if gold is ripping to new highs every single day, that's usually a fear factor attached to it. Especially when you get moves like this, people are very scared. So it's possible that we are in the process of consolidating. And while I do still think gold could continue to move higher, maybe we don't see it happen with the urgency that has been recently happening. Again, this is a bit of a hedge in my portfolio as I am long individual stocks and also watching the indices. I do have a stop loss on my gold trade, and it as a 1/2 size position. So if this thing breaks lower, that's going to be my signal to take a loss on the trade. Another positive catalyst is when we take a look at the inflation story on the producer price index and consumer price index level. We do still see a inflation trend to the downside, which is a good thing for the Fed's ability to cut interest rates. And in case you haven't already heard, our Edge Finder sale is coming to a close. This is the biggest discount that we do all year long. And to be fully transparent, and this is not a sales gimmick, we do plan on doing this. We plan on raising prices this year for the Edge Finder. So this is truly your last chance to pick up a copy at the lowest price that we'll be doing all year long. And for subscribers watching this video right now, we'll give you an extra 5% off if you use the first link in the description to send a direct message to our support team. This allows you to ask questions about the tool, and it allows us to make sure that you're a good fit for the tool and that it actually will benefit you in your trading journey. So if you're looking to incorporate fundamental analysis, sentiment analysis, and string it all together with a data sourcing tool that brings it all into one place, consider the Edge Finder and don't miss the sale with that 45% off discount. And when we look at the probabilities for a rate cut in the upcoming May meeting, which is the 7th of May, it is very unlikely that we get a rate cut according to the market, with a 93% chance that we are going to hold interest rates steady. However, once you jump into June, the market is actually expecting a rate cut, and there is also a slight possibility that we'll get a juicier rate cut by then of 50 basis points or 0.5%. Taking a look at the US dollar in reaction to what we just discussed, we can see that the dollar has pretty much stabilized around current levels. But if we do get a retracement up into levels like the 38.2 to 61.8% retracement zone, I think this area might be a spot where I start looking for possible sell continuation trades. The reason for this is that between the uncertainties in the tariff situation, as well as, of course, some deterioration in the inflation story, which was part of the bullish catalyst for the dollar, we're seeing inflation cooling and we're seeing some softness in US economic data. I continue to prefer other currencies in the short term over the US dollar. So if we get a spike in the US dollar, what would I be watching? So I pulled up the top setups page, and what I've done is I've filtered only for major and minor currency pairs, and I've also excluded neutral readings so that we can only see Edge Finder confirmation ideas on the screen. And when I look at this, a couple things that stick out to me are, of course, the Kiwi dollar, the pound dollar, the euro dollar, and the Australian dollar on the long side or with a bullish bias. At the same time, we can see dollar Swiss, dollar CAD, and euro pound getting some bearish readings on the Edge Finder when factoring in sentiment, technical, and economic data screens. And the Kiwi dollar is one that I'm especially interested in if we can get a pullback down towards this 38.2% retracement. I'm really liking that round number play at 5,800. The pound is also interesting at a 50% retracement around 1.31, and the euro may be interesting around this 1.13 level if we get a little bit of a sell-off there. On the bearish side, I'm looking for retracement potential in the dollar against the Canadian dollar, somewhere between the 38.2 and 61.8% retracement zones. If I take these trades, they'll be shared directly in our Discord server. Within our Discord server, you can see all the trades that we're taking, and more importantly, why we're taking them, with full context included with every single alert. If you're not a member and would like to be, please feel free to chat with us using the first link in the description. And today's video is sponsored by Vantage. Vantage Markets allows traders outside of the United States to get low trading fees, trade CFDs on pretty much everything, whether that be stocks or Bitcoin or pretty much whatever you want. They have a ton of different products that you can trade using their CFD trading platform. Things like XAU USD, NASDAQ 100, and even the Russell are all available to their clients. They have low trading fees, and for my subscribers, for a limited time, they offer a special sign-up welcome bonus, which you can take advantage of by using the link in the description of this video down below. I'll also leave this as a pinned comment in the comment section so that you can take advantage of this special offer while it lasts. Right? If you're watching the dollar index, what's really key here is you don't really, like if you're talking like stock market related stuff, like indices, etc., stability wise, you really just want to see the dollar chill out, not go too far in one direction. If the dollar index is like ripping higher here, I guess that's arguably it's kind of strange, right? If the dollar's like plummeting, like if you get that move on the dollar, that is signaling that a recession is coming, right? Big time. Like if you get a plummet in the dollar, that's saying, oh, US recession is on the table. Whereas if you get this move, that's telling you markets may be worried about inflation. But in some ways, you could argue that stability in the dollar to the upside would also be okay for the macro, the big situation. I don't know. It's kind of tricky. I think what you really want, if you're a stock market bull, is something like this. You just want dollar to chill out, not go too far. You don't want it to plummet. Like people are saying, well, that would give you rate cuts. Well, yes, but you'd probably be entering into a recession. You don't want rate cuts. This is where people get it wrong. You don't want rate cuts because the economy is crashing. You want rate cuts because cooling inflation and the Fed can cut, right? There is two types of rate cuts. There's rate cuts where the Fed can cut, and the ugly one where the Fed has to cut, right? And this is where you say, if the Fed has to cut, dollar index just plummets, right? If the if the Fed can cut, but doesn't have any, significant urgency to cut interest rates, then what happens to the dollars relative to other currencies? This is why Forex is hard, right? Forex is hard because you have to consider not just the US, but you have to consider other countries as well if you're going to be a fundamentalist on Forex, right? So if you're looking at the euro, well, do they need to cut? Yeah, their economy is worse than ours, right? Growth-wise. Now, that could change over time with all the tariff drama. Who knows? But right now, the ECB has been cutting rates aggressively. So they're already cutting interest rates. They kind of have to, right? So if the Fed can cut rates but doesn't need to rush to do so, that's different than the ECB who has to, right? So understand what this means. A central bank can cut interest rates, or a central bank has to cut interest rates, depending on what the data is telling you. First question is from Marco, who's been trading for 3+ years. Their goal is to find a profitable trading strategy. They do not have any of our tools, but are interested. Like I said, don't miss that sale event. It's ending soon. Nick, Trading Economics has a forecast for S&P 500, which is bearish for Q2, Q3, and Q4. Does that contradict the current sentiment? I wouldn't read too far into those sorts of things, Marco. I mean, wouldn't it be nice if there was a magical, fortune-telling forecast for S&P 500? Doesn't mean that it's not valuable information, but I think, I've seen those sorts of forecasts online. I wouldn't read too far into them simply because you don't really fully understand the mechanisms behind why that forecast is the way it is. So I would come up with your own forecast. I would understand the fundamentals. I would focus on what the Fed focuses on. That's what we do here at A1, and really hone in on inflation, jobs data, etc. And I would come up with your own forecast. That's the truth. I don't love the idea. Like, I don't use any of that sort of stuff to try and tell me exactly where the S&P 500 is going to be in Q4 of 2025. Nobody knows, right? There's so much unknown that could happen between now and then. Xavier's been trading for 1 to 3 years. Their goal is to become a funded trader, and they are interested in our stuff. Don't currently have it. Don't miss the sale. What is your win rate and risk to reward? I understand you trail your profits and vary position sizing, but when you set up your trade on TradingView, the long to short position template does not look like a 1-to-1 risk to reward. Great question. So I just use, when it comes to the risk to reward tool on TradingView, these are not orders for me on the take profit side. On the stop loss, I do have a stop on gold here, but I do not have a take profit here for gold. Like, technically, I could take this and I could just stretch it out and never see the top of it, right? So that's, I don't use a strict risk to reward. So when you ask what's your risk to reward, I don't really have one, right? So I know what I'm risking. I know a amount that I'm risking. Usually it's less than 1% on my portfolio within a singular trade, right? So if I'm out of the trade, I know I'm going to probably lose less than 1% on my portfolio's value. If I'm right, a good trade, some of my best trades, like this gold trade I had over here, that was like I'm just going to give you a very rough, I don't really look at risk to reward that much, to be honest, like what the final risk to reward comes out to, but I'm just going to give you a rough, maybe like a 6 to 7 R trade is what it ended up being, which was a pretty phenomenal move for me. But yeah, I mean, I don't focus too much on that. Honestly, what I do is I just back test my system. I manage my risk. I focus way more on my risk than I do on my reward. And in terms of win rate, again, tricky because win rate has, especially with my style of trading, which I have, this is pretty much what happens. I have lots of small losses, right? Lots of small wins and a very little bit of big wins, right? Very infrequently do I get big winners like this, but they pay for pretty much all the small losses and the frustration of the small wins. I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.